Good afternoon. Thank you for joining us today for Kolibri Global Energy's operational update in 2024 forecast. Kolibri trades under the ticker symbol KEI on the Toronto Stock Exchange and KGEI on the NASDAQ. With us today from the company are President and CEO Wolf Regener and CFO Gary Johnson. I will turn it over to the company to run through their budget and operational update that they provided last week, and then open it up for Q&A. Please enter your questions in the Q&A box or email me at jessica@adcap.ca. The presentation may contain forward-looking statements. Welcome, gentlemen, and over to you.
All right, thanks, Jessica. Yep, like Jessica said, forward-looking information. This is our corporate presentation, so you can see all this on the website, disclaimers, and then we talk about non-GAAP information. So here's our non-GAAP disclaimers, etc. I'm going to flip through most of these slides just because everyone, I think, knows what it is, and we're just trying to give an update. So we'll go down to where we are here, company, where we are. As you can tell, stock-wise, we pulled back a little bit here, as a lot of the oil and gas companies have, especially the Canadian side of things. Shares outstanding, 35.6 million. Market cap, about 153 million Canadian, 114 million US. Net debt of 23.3 as of third quarter of last year, which were our last financials that are out, and gives us a U.S. enterprise value of about 130 million. Debt to adjusted EBITDA of 0.66, and an enterprise value versus proved BOE of $3.82 US. Now, comparing that to our reserves, our approved reserves of 33.3 million BOE gave us a value at the end of 2022 of 515 million. Our reserve report for the end of 2023 still being worked on by Netherlands Sewell. We hope to have that out here mid to late March, depending on when they're done with everything. So once they're done, then we'll release those right away. Proved and probable reserves of 54.4 million BOEs. Gave us a $724 million value, or gave them, I should say, because these are Netherlands Sewell's numbers. And that's versus our market cap here of 114 million US. So big discrepancy between what our proved reserves value is versus where our market cap is. 2024, what we're planning on doing, continuing development of the Tishomingo field. Our forecasted production continues to grow, 25 to 33% over our 2023 guidance is what we're projecting. Second quarter planned activity is drilling and completing 2 Caney wells. And third and fourth quarter, we're drilling 3 additional Caney wells. That's in addition to the 2 Velan wells that we had drilled already. And we'll be completing those wells together with the 2 already drilled. That's what our forecast is for. And then we're also continuing to gather and analyze data from the 2023 wells we drilled, where we ran tracers, looking at flow back and pressure data, because the last Emery wells did flow back a little differently than our previous wells. So we're analyzing that as far as what determined what was the cause of that, and whether that's a good thing or a bad thing in the long term. Analysis will determine the timing of the next T-zone well, just because we think that the T-zone may have interfered with the 2 Caney wells. The T-zone, as a reminder, is just below the 2 Caney wells and in between it. And we did encounter more natural fracturing here. And so we think that the T-zone actually pushed some fluid up into the Caney. And that's the reason, one of the reasons for the additional flowback fluid that we're getting, and that the flowback has been a little different than what we had in the past. So if they're all connected up completely, because of the area that is more naturally fractured here, then the spacing would have been more like 9 to 10 wells per section, versus what we were trying to do in the Caney of 6 wells per section, with the T-zone isolated down below it. And we'll determine what we do going forward, but we felt the prudent thing to do was just focus on the Caney here for the next couple pads. And then we'll determine what the timing would be for future T-zone wells, whether we should do them at the same time with the Caney, or whether we come in later to drill the T-zone after the Caney has produced for a little while. And then it would almost be a secondary frac into the Caney if there's communication between the two. And if not, then you have virgin T-zone and it's isolated anyway. So anyway, those are the kind of data that we're looking at to analyze and determine here over the next few months as far as what our path going forward is. And with that, let me turn it over to Gary here for our forecast.
Thanks everyone for joining the webinar. I'm going to review the 2024 forecast that we released last week. The forecast assumes the drilling activity that Wolf just discussed. As you can see, as we continue to develop the field, we are forecasting solid growth in production revenue and adjusted EBITDA in the coming year on top of the 2023 increases that we forecasted last year. So let me get to the forecast. All amounts are in US dollars, and we use the $72 oil price for the entire year. We're forecasting average production for the year to be between 3,500 and 4,000 BOE per day, which is an increase of between 25 and 33% from the 2023 guidance. Revenue for 2024 is expected in the range of 60 to 65 million, which would be an 18 to 23% increase from the 2023 forecast. We are forecasting adjusted EBITDA to be 46 million to 51 million, which is an 18 to 24% increase from the prior year forecast. And as you can see from the chart on the right, our adjusted EBITDA was 6.6 million in 2021, and our 2024 forecast shows an increase of 600% from that year. Capital spending for the year is expected to be in the range of 33 to 39 million, and our net debt at the end of the year is expected to be 25 to 27 million. And lastly, the forecast for EV over adjusted EBITDA is in the range of 2.56 to 2.83. And then the last thing I want to say is we did announce a shareholder return policy during the year that we would consider a shareholder return policy during the year. And this, I just wanted to mention that the current forecast does not include the impact of that policy since it has not been approved by the board yet. And now I'll hand it back to Wolf to finish the presentation.
All right, thanks, Gary. Just a couple of graphs here. These are what's in our presentation have been, but production, as you can see, that we've had a big production growth since we really started the drilling activity back in 2022. This was all slow decline from wells we had drilled in previous years. Big increase has been from the wells we've been drilling, and as you can see, the production is still growing per our forecast as well. Same with the operating net income, where you have here, which tracks the WTI price of oil. And so even as that's gone up or down, we've been climbing on our net operating income, and that's our forecast for going forward as well. Production in third quarter was 2,700 BOE a day, roughly. And we had announced in early January 2024, right before we had a bit of a cold freeze, which I'm sure everyone knows that shut down a lot of production in the US. We were producing about 3,800 BOE a day. The cold snap is over and we've returned production back up. So you can expect that to be back up around those numbers. Infrastructure, just as a reminder, all in place. Gathering systems less than a mile from all approved locations. Had 180 booked locations at the end of 2022. 60 proved, 63 probable, 57 possible on 17,000 net acres. 29 wells are on production. Acreage is 88% held by production. Additional upside from the T-zone and ultimate recovery. You can see that year after year, the reservoir looks healthy. Netherland Sewell has been increasing every year what the estimated recovery is going to be from these wells going forward. New slide that we threw in. One of the things we mentioned is that we were drilling wells for less and less money. So we went into 2023 with a forecast of $7.2 million each for drilled, completed, and facilities on each well. And the last two Emery wells were drilled and completed for $5.4 million. On the right here, you can see how many average drilling days we've had when we were drilling wells. In 2016, it was about 29, 17 was 32. And we started getting more and more efficient at what we were doing. You know, we're striving for constant improvement, always looking to try new things, see what works in order to speed up things and to save costs. And you can see that it's gone better and better every year. And then this year we had a dramatic difference once we switched to some new downhole tools with the last two Emery wells. And you can actually see this was the one well before the Emery well, before we switched to those tools. And you can see that it was already making a difference, but we switched it out here in this 7,000 foot range. And then used those same tools down for these last two wells, which really sped up the time down to 11 days. So big improvements from our field. Very proud of our staff that we're constantly looking for improvements. And that's our goal, to constantly see where we can do things better, have better productivity, both on a cost point of view, timing point of view, and hopefully production point of view. And really, that's about it. Remind everyone that we're so undervalued compared to a lot of our peers. Same thing on the proved probable number. And then our operating netbacks, these are from second quarter of last year, still haven't updated to the third quarter yet. You can see our operating netbacks in the US dollars converted from our Canadian peers are drastically higher on our netback basis. And OPEX as well. If you look here, our OPEX is down to the lower end of things. Whereas the ones that are nearest to us are actually natural gas producers that don't really have lifting costs. And then I ran some as well for peers on the US side of things on a BOE basis, without hedging, mind you, as all these. But we're looking really good on that front as well as far as netbacks go. We have the highest netbacks from our peers here. And with that, I will leave it on this slide and open it up to see if there's any questions or anything.
I just have a few questions for you. A good run through. What I think might be important to touch on, the previous wells prior to the last Emery wells that you just drilled were cleaning up in about 10 days. And as you said, there was, much more frac fluid that was flowing back. And if you can kind of dumb that down for the layman, because it's really a technical issue, not a reservoir issue. And I think it's important to understand the difference. So if you can get a little more color on that, that would be helpful.
Yeah. So in the Emery location, when we were drilling the wells and what we found when we were fracture stimulating them and flowing back, it appears to be an area where the rock is naturally broken up more, so naturally fractured. And that's kind of what we put in the press release, was that we're in an area of more natural fractures. And so what we think happened is we drilled the two Caney wells that we fracture stimulated, so we put in a lot of fluid like we always do. When we flow back in past, we've only gotten, I would say in the first 10 days, so 5, 6, 7% of our frac fluid back. And we generally don't get very much of our frac fluid back, even over a couple of years. We're in the 15 to 17% range, let's say. With these wells, we were getting a lot more of our fracture stimulation fluid back. And we're not positive on if it's just because of the natural fracturing that's flowing back easier, or if it's because we have the T-zone and the two Caney wells so tight together. If there's not a great barrier between because of the natural fracturing, then you have a lot of fluid in a small area, and we might be flowing it back then. And so that's really what we're looking for data-wise as far as why. And that's why we also decided to not drill a next T-zone well. If it was because of the T-zone being fracture stimulated at the same time, that it interfered with giving a different flow back, and we don't know if that's good or bad in the long run. The safe thing to do is not to drill another T-zone well when we're drilling the Caney wells right now until we get more data back over the next couple of months. And the tracers and things like that we put in, which is things that you put in as you're fracture stimulating, and it binds to oil and to water. And so we'll see where those come back, so we can get more data on and understanding what was going on. But it'll take a few months of flow back in order to achieve that.
Okay, thank you. That's helpful. So, I mean, if you had more natural fracturing in that area, do you think your ultimate recoveries could be better?
We don't know. It's too early to tell. So, I mean, if we just stay where we were on recoveries on ultimate EURs,
which are great anyway,
which are in great shape. So I'm not looking for anything better at this point at all. So.
Okay. Now, I mean, this shows the variability of of Mother Nature and geology, etc. So the T-zone was more fractured, obviously, in this area than it was in the first well, in the first one you completed. But this in your mind, from what you're saying and picking up, does not eliminate the economic viability of the T-zone.
Correct. Yeah, it's more of a timing thing. Should we do it at the same time? And if we do it at the same time, in some areas of the field, if there's more natural fracturing, it might interfere with the KGEI, but it might not. So it might be the best way to go. Or likewise, is it better to fracture stimulate the KGEI wells, produce those back for a little while, then fracture stimulate the T-zone underneath it, drill and fracture stimulate, I should say, and develop the T-zone. And if it does frack up into the KGEI a little bit, it would just be fracture stimulating the KGEI a little bit more at that point.
Okay, helpful. So, and of course, you did have to shut in the offsetting wells in order to complete these, and it's taking a while for them to come back. Do you expect them to? How much? How we think it'd be about 2 to 3 more months for them to recover?
Yeah, it's hard to tell, right? So because it's flowing back differently, everything around it is acting a little differently because of that as well. So our best guess was that it's going to be a few months until things come back, and we expect the close-in wells not necessarily to get back to 100%. We're modeling that they get back to around 80%, just because they're close in. There might because of the fluid that's still there. But we'll see. We'll just need some time and see where they come back to and how long it takes.
This is why oil and gas is such a fun business. Nothing is ever predictable as much as you try to make it. So just on the 2 Velen wells, you said you're not completing them to the second half of the year. And at the same time as you drill, as you complete the 6 to 7 additional wells you're drilling this year, and if you could maybe just touch on why that is as well.
Yeah, so we, in some parts of the field with what we currently know, and that's really in the flow back from what just happened with the Emery wells, that we think it might be best to fracture stimulate more wells in one area and just focus on one area of the field, completing more at a time, and then moving to a different part of the field and doing the same thing, doing it more in clusters in certain parts of the field. Whereas other parts of the field, we can feel comfortable with that we are potentially just doing 2 or 3 well pads, and it's not going to interfere with anything around it. So it'll just depend where on the field, and as we get more data, then we'll learn more about what's going on and what the best possible, development is for the field in general, in order to maximize value on the entire field.
Okay. I'm just sorry. I'm reading questions while listening to you. I think we just answered this one. So, okay. I realize your shareholder, return to shareholder plan has to be approved by the board. It'll be subject to a lot of variables.
Right.
Would you be leaning more toward a buyback given what it is, the discount you trade at to NAV versus a dividend, do you think?
Yeah, it's hard to say. I mean, we'll discuss that at the board. There's pros and cons for doing each. But yeah, if I think that the share price is too low, then I think it's probably going to be leaning more toward a buyback. Share price is a bit higher, then maybe a dividend makes more sense. So we'll have to evaluate that where we're at when that time comes, and we'll be discussing along with the whole board that on a kind of a quarter by quarter basis as far as what the timing of that is as well, because I'm sure that's going to be a question that people come up with.
And I'm sure you have to find the ideal production for the field as well before you can deliver that as well. Yeah. One other question, and this is something you're not going to really be able to answer, but you looked at the increased EURs coming from Netherlands Sewell, and now you have a whole bunch of more longer dated data with your newer drilling techniques. I know prices are going to be lower, so you might get hit on that in your reserve report, but there was variability in those previous reserve reports as well, and your EURs kept coming up. So, I mean, I know you can't answer the question until you talk to them, but I mean, I think it's something kind of that could be a positive. Anyway, could go the positive.
No idea.
Yeah. Okay.
Yeah. So we'll see what they come up with and see how conservative they are, and they're always conservative, right? But
they always. But
the field has been performing really well, in general. So we'll see what they do. Okay. I don't
think I really had much else other than just to highlight the fact that you've got the highest netbacks pretty much in your peer group, even with the lower oil prices. Your costs have been improving dramatically. You're trading at a lower valuation than anything else I look at on every single metric. So, and growing production 30%, ascending under cash flow. So I can't see a better entry point than around here when I am very constructive on oil for the second half. Is there anything you can poke holes in that I'm saying?
No, I was just going to say that, look, I mean, I think we are moving forward. We're growing every year. And, we're a good solid company, not taking a whole lot of risks on on anything that's out of the normal oil and gas side of things. We're learning more about how to develop the field in the best possible fashion. We're doing that in a constrained manner to be careful, so that we really want to produce everything that we can out of this field and maximize the value. We think we're going about it the right way and still growing. And hopefully later on this year, we'll be able to return some cash to shareholders so that they get rewarded no matter where the stock price is.
Yeah, exactly. No, I mean, and I think it's important to focus on the fact that delays are not, you had a slight delay, but that's not really a negative. It just, you're just learning more, and it makes it the way you develop the field. You have much more information on that. So that's
you have to adjust. I mean, a small company, and by delay,
there was stuff that was under your control, like the freeze off, and
I was just going to say, that happens in this business. That's nothing.
That's
but,
right.
I assume the delay. I assume you mean by not completing the deal in Wells, but I think that's the proper thing to do, and that's what we need to be doing. We have to be, a nimble company, and that's how we do better than others. And if we don't make those choices, then we're going about it the wrong way. And like you said, you learn as you go through exploration, through development, and you have to make adjustments. And so that's what we're doing.
That's exactly what
the company and the shareholders.
Yeah, that was exactly the answer I wanted. So yeah. Okay. Anything else? That I don't think there's any more questions. So I guess that's it for today. It was a quickie.
Yeah.
So thanks very much for your time, and I hope that answers anyone's questions. If you still have more, please email me at jessica@adcap.ca, and I'd be happy to assist. Thanks.
Thanks everyone for joining.
Okay.
I appreciate it. Thanks, Jessica.
Okay. Bye.
All right. Take care.